Thanks for the invitation, and thank you everyone for being here. Pardon the voice, a little bit raspy today. So I'm Jake Bernstein. I've been trading for 52 years. That's more than half a century. I've written 45 books on trading. Been on Wall Street Week, CNBC, CNN, Financial News Network. I've spoken at 800 conferences and webinars all over the world. I'm a real trader. I really trade. So let me give you some good news and let me give you some bad news. The good news is this webinar is free. The bad news is that if you came here expecting that you're going to learn something that's going to make you money in 45 minutes and not pay anything for it, you will be sadly disappointed. The better news is I have nothing to sell you. I have no special offers, no special deals, no discounts, nothing. I have an idea to sell you, which if you do properly, will make you money. But knowing what I know about traders and what I've learned in the last 50 years, most people don't have the discipline to do it. I trust that you will have the discipline. A couple of other things I'd like to tell you. Most of the things that are available to traders these days are useless and worthless because they require interpretation and judgment. It's one thing to look at a chart and say, that was a bottom, that was a top. But when you're living it, tick by tick, moment to moment, day by day, the feelings are very different. So 20/20 hindsight is a wonderful thing. I will use some 20/20 hindsight today in teaching you some things, but I want you to learn the process because I have a very specific process for you today that involves 5 simple steps. The steps are easy, completely objective, and 100 people who know the methodology looking at the same information at the same time will reach the same conclusion. So we're not talking about Elliott wave or Fibonacci, which is subject to interpretation. We're talking about reality, procedure, and steps. So before we begin, nothing I have for you today is perfect. We all make stupid mistakes. If you can keep your stupid mistakes to a minimum, you eventually will make money if you're using methodologies that are reliable. So if you're consistent and you begin with enough capital, what I'm showing for you today will work in any time frame and in any market, but you need to be able to do it consistently. One of the good news things about the internet today is it gives you a lot of information. That's also the bad news. There is so much information out there that people get confused and look at too many things and can't make decisions properly. You need to have focus. Don't mix methods or time frames. Find what works for you. Do it with focus and consistency. You need to find your place and trade within that place. What do I mean by that? Make your decision. Are you a day trader? Are you a short-term trader? Are you an investor? Are you an options trader? You want to trade Forex? Do you want to trade spreads? Do you want to be a scalper? You need to decide. You can't be all of them unless you have people working for you. Do a few things really well rather than many things poorly. Now let's talk about the 2 most important concepts in the markets, normal and abnormal. If you understand normal market behavior, you understand the basics of trading. I'm not interested in normal. Normal teaches me nothing about the market. I'm interested in abnormal. When do things in the market become abnormal? When are they not following the rules? That's where we make our big money, and that's what the method is about today. I'm going to show you divergence, which is the most powerful concept in the market. It's something that has made me a lot of money and will continue to make me money, provided I use it correctly. So today, we're going to do something really simple. We're going to use divergence. We're going to use targets. We're going to use a trading model. We're going to have no analysis, no looks like, no interpretation, no guesswork. We will know our stops and targets in advance. It will work in all time frames. It's a damn cookbook. But first, let's talk about divergence. Divergence in the market is very simple. When 2 things move in opposite directions at the same time, they diverge. Most of the time, market activity is normal. When it becomes abnormal, I become interested in it. Let me give you an example of what I mean. I'm going to skip this for just a moment. Let's look at this chart. This is a normal relationship between momentum and price. Before we go there, let's talk about momentum. Momentum is the most simple indicator there is. Sometimes it's called rate of change. Sometimes it's called momentum. It's really simple. Let me give you an example. If I'm looking at the momentum, the 10-day momentum, I'm comparing the price today with what it was 10 days ago. Example, if the price today is 50 and the price 10 days ago is 50, the momentum is 0. 50 minus 50, 0. The market has not gone anywhere, and momentum is showing that. If the price today is 60 and the price 10 days ago was 50, the momentum is plus 10, subtracting 50 from 60. If the price today is 50 and the price 10 days ago was 60, the momentum is minus 10. Calculating momentum is so simple, even a computer can do it. So let's compare. I have a chart here that has two things on it. Price on the top, momentum on the bottom. And you'll notice I use bar charts, not candle charts. Candle charts are too difficult for me to understand. They have never made me money. So, going to the left, the two big red arrows down. Price and momentum are moving in the same direction. Toward the middle of the chart, in August, price and momentum begin to move up together. So they're doing the same thing at the same time here. Normal. Now they start to move down together. Normal. Now they start to move up together. Normal. Now they move down together. Normal. Everything is normal. Price makes a new high. Momentum makes a new high. Price makes a new low. Momentum makes a new low. This chart teaches me nothing. Let's go to the next one. Now let's look at the situation. Another example, crude oil. For a long time, price and momentum are moving in the same direction. Nothing has happened of significance. Over here, price and momentum are moving in the same direction, but over here, things are starting to look a little bit different. How do I mean that? Let me show you. Price goes down, momentum goes down. Momentum goes up. That's abnormal behavior. And you will notice that abnormal behavior preceded a big move up. So again, normal, normal, abnormal. The question is, how do we spot these abnormal patterns? Normal patterns are easy to spot if you use the right procedure. In order to use the right procedure, one moment, ladies and gentlemen, I'm going to get a drink of water. I'll be right back. Don't go away. Okay, that's better. So what we need to do is find these periods where price and momentum diverge. The momentum that we use, and by the way, I want you to know, everything I do is specific. No guesswork, no interpretation. If you need to interpret anything by looking at a chart and saying, it looks like the market wants to bottom, it looks like the market wants to top, you're going to get into trouble. We're not interested in looks like. We're interested in, is there a low? Is there not a low? Is there a setup? Is there a trigger? And if so, what is the follow through? It's a very simple process, rule-based. And as I said before, if 50 people, 100 people, 1,000 people looking at the same information, independent of each other, can reach the same conclusion, I will have done my work. So let's take a look at it in detail. The momentum we'll use is momentum 28. In your software, it may be called rate of change, but it's 28. What does that mean? It means that every point on the momentum chart is looking at the price today, subtracted from the price 28 days ago. So even though they move in the same direction, there are times when they don't move in the same direction. This divergence, as shown right in the middle of the chart in the big blue square, indicates, in my view, professional buying. So while the small trader continues to get out and unload their positions over here, there's a process going on under the surface of accumulation, and we can measure this specifically. Let me show you what I mean. I'm going to show you a cookbook. Please pay attention to the cookbook. If you get this right, you will really be happy with what I taught you, and then you'll send me a letter or an email and say, Jake, you changed my life for the positive. I can't believe this was so easy. I'm seeing it now. Let me teach you the process, step by step. If you don't understand it, send me an email. I'll send you a webinar for free. The greatest gift to me will be you saying to me that I changed your life and gave you some very valuable information, and it didn't cost you anything. Here we go. The first thing I look at is a window of 60 price bars. They could be 5-minute bars, 10-minute bars, 30-minute, 60-minute, 360, daily, monthly, weekly. Doesn't matter. Each bar represents one time unit. This bar to the left, right over here, represents 60. So at any point in time, I'm looking back 60 for my window. So if I was going to make a decision right here, I'd be looking at these 60 bars. Back here, going back 60 bars from here, this was the lowest low. When I say the lowest low, I mean the lowest intra-bar low. There's no interpretation, no question of it. So I'm asking these questions in the same sequence that I'm telling you now. If you ask the questions in the sequence I'm telling you now, you will never miss an opportunity to spot divergence at the top or at the bottom. So here we go. Lowest low in price. Question number 1. Is that also the lowest momentum 28? Right over here? No. This would be point A, point B. If this is not the lowest momentum and the lowest price, I have a divergence developing, a positive divergence, a bullish divergence. There will be a bottom here at some point. Step number 3, find the lowest momentum within the 60-bar window previous to point B. Right over here. We all agree on that. Unless you've got a learning disability, or unless I'm a bad teacher, which I'm not, you will see exactly what I'm talking to you about. So let's number these points. A, B, C, and directly above C is point D. A is lower than D, while B is higher than C. They're all going to look structurally exactly the same as this. We need to have at least 6 price bars between points B and C. To review, this is point B, this is point C. Can you believe it? I'm actually teaching you something unbelievable. So we've got 6 price bars between these. Absolutely. We have a qualified bullish divergence setup. A setup is not a trigger. Many times these divergences will appear and disappear. We can't take action unless there's a trigger. The trigger is very simple. Closing above the highest momentum between points B and C constitutes a trigger. So where is that highest momentum? Let me show it to you. It's right here. A, B, C, D, highest momentum, E. And if you're not sure, guess what? It's a number. All you have to do is look at the number. Is the number high? Is the number the highest one between these 2 points? If it is, that's our point E. Closing, and I stress, closing above that number gives us a buy trigger. How does that look? It looks like this. A, B, C, D, and E. Let's do it again. Point A, point B, point C, point D, point E, waiting for a trigger. The work is absolutely exact. No interpretation. So if you do your work and I do my work, and I say we had a trigger, you say we didn't have a trigger, no worry. The absolute definitive answer is in the numbers, because I'm a numbers guy. The only thing that has ever made me money consistently has been numbers. So again, no interpretation, no looks like, no could be, no my opinion is. I'd have no opinion. My opinion is my work. Let's go back. Let's go to another one. In fact, this is so easy, we've actually programmed the computer to do it for us, to spot these points. If it wasn't strictly mechanical and completely objective, the computer couldn't find these and find our point for us. So let's look at another one. We're going to go through and do some detailed work. Let's look at the opposite situation. How did Apple reach its peak way back in 2015? I want you to look at the chart at the exact opposite situation. What do I mean by that? Think, but don't think too much because you make a mistake. Find the highest high in price, the exact opposite situation. A. Ask the question, is that also the highest momentum? No, there is negative divergence here. This stock will top, but not unless there's a trigger. Find the highest momentum previous to point B, which I think you will agree is right over here. Come on, computer, where's my pointer? Right over here. And then right over here. So now we have the opposite situation. A is higher than D, while B is lower than C. Find the lowest momentum between the two, 2.08. When we close below that momentum, trigger to go short, which was approximately right over here, just a few days from the top. How good is that? Now, if you're thinking, this is all old stuff, I'm going to show you some new stuff. So just bear with me. Let me reiterate. The process is really simple. Number one. Number two, it's totally objective. No interpretation. Number three, it follows a pattern. Let me tell you what I mean by that. I'm going to go back to a previous slide. Just bear with me. We use what I call the setup, trigger, follow-through method. Setup, trigger, follow-through. Every trade has a setup. The setup consists of a pattern. The pattern we're using today is divergence. The simple fact that a pattern has developed doesn't mean it's time to take action. Every pattern must have a trigger. And if you can come away from today, from my talk today, with this one concept, setup, trigger, follow-through, I feel I will have accomplished my goal and passed on knowledge to you that took me about 15 years to get when I first started trading. Setup, trigger, follow-through. In this case, the setup is A, B, C, D, E. Penetrating the E point is the trigger. But after the trigger, we need something else. We need the thing that most people screw up every time. Follow-through. Follow-through consists of two parts. Knowing when to take your loss and knowing how to maximize your profit. Many people have called me up during the years and said, Jake, I think I'm a good trader. Want to know why I'm a good trader? I say, why are you a good trader, Joe? He says, because I know when to take my losses. Well, that's wonderful. Knowing when to take your losses and taking them accordingly is not going to make you rich. You need to be able to maximize your profits. So follow-through consists of two parts. Profit maximizing strategy and limiting your loss, being a risk manager. Setup, trigger, follow-through. So let's go back to the trading model right over here. And here are the rules, by the way. So when you get the playback of this, webinar, you can go back and look at the rules. And if you still don't get it, let me know. I'll send you a webinar that teaches this in even greater detail. And there will be no charge for it. So let's go back to here. Again, normal, abnormal. So looking at this situation, here's my point AB right over here. Hold on a moment. A and B right over here at the low. CD, E, waiting for a trigger. Now, how long can you wait for a trigger? The trigger could occur at any point in time unless the C point over here at the lower left falls out of the window, because the window is always moving forward. So again, we're not going to be making trades just because there's a setup. The setup can disappear very quickly if it moves past the 60-day window. So where the hell do these numbers come from? Momentum 28, 6 days in the window, 60 bars in the entire period. These come from research. These are not numbers that are just pulled out of my you-know-what. These are numbers that came from research and trading. So let's go forward and look at a couple of more. Here's another one, like I said before. A is the lowest low in price. B is the momentum directly below it. C is the low previous to point B. And D is the price corresponding to point C. Very exact work. So what do we need now? It's a setup. I'm very confident this particular market is going to trigger, but I need a trigger. And that trigger would be the momentum above the highest point between the two. Let's look at another one. Here's again the trigger rules. Similar situation, A, B, C, D, and E. A, B, C, D, E. This was the point right here, and trigger. Let's look at another one. Let's go back to Apple. Now, what else do we need? I want you to think back to what I said. And by the way, if this sounds like I'm lecturing at you, I am. I'm not giving you a bunch of interpretive nonsense. I'm giving you something very specific. And I encourage you not to believe me. Try it yourself. Don't believe anything I'm telling you until you've tried it yourself and seen it with your own eyes. When you do, you'll be amazed. So let's look at it again. The opposite situation, a bearish divergence. This market is about to top, but it's not going to top until we get a trigger. And by the way, divergence will not spot all market tops and bottoms. It will spot many of them. Therefore, we use several other indicators in the same way. We use momentum, MACD, CCI, and detrended oscillator. All of them will give you signals for divergence. And if you use all four, you will catch most significant tops and bottoms in most time frames. So what happened? Think back to what I said. Setup, trigger, follow through. The setup is shown with the two parallel lines. New high in price, point A, B, C, D, E, trigger. So we've got setup and trigger all taken care of. What else do we need? We need follow through. Follow through is the profit target and the stop. We measure the range between the highest high and the lowest low during the period of divergence. Let me show you what I mean. Let me get my pointer here. This is the highest high. This is the lowest low. The distance, the dollars, the range between this low and this high constitute the risk, the full target, and half of that around constitutes the first target. You can see what happened after the trigger. The trigger was right approximately here. One moment, let me get my pointer again. It keeps disappearing. So the trigger was over here. You can see that over the next several weeks, several months, we had a significant decline, and that decline reached all of its profit targets and then some. So we need setup, trigger, follow through, consisting of stop loss, 2 profit targets, and a follow-through procedure for maximizing the profit. Now, you might look at this chart and say, well, wait a minute. You mean my risk on this trade would have been everything from here to here? That's too much risk for me, you might say. I say, no problem. Trade a smaller number of shares. Don't trade the stock. Buy a put option. Do a strategy. Do a spread. Or don't trade it at all. You have the choice. But here's the thing. We know ahead of time what our risk is going to be before we get into the trade. So therefore, the time to get nervous about a potential loss is not after you're in the trade, but before you get in it. And if it makes you nervous before you trade it, don't get in to begin with. It's really simple. Now, the great speaker ahead of me just showed some very significant tops and bottoms using a RSI indicator. Very nice work, beautiful charts. The question is, during that period of time where the RSI was very low and the stock continued to go down, what was the risk? What was the fear factor? Those are the things that are important because that's where traders screw up. If you know your risk ahead of time, don't take the trade if it's not right for you. But let's go on and look at a few more. Here's another one. And again, notice the procedure never changes. It's always the same. And you're saying, well, he's showing me old charts. Well, I've got to show you some old charts to show you the concept, but we're going to look at some new charts pretty soon. Again, the same procedure. It's a cookbook, like I said. Find the lowest low in price, right over here. Point A, which is the vertical line to the right. Is that the lowest momentum? No, point B. Lowest momentum goes all the way back to point C, right over here, which correlates to point D. So again, the same paradigm, the same model. A is lower than D, while B is higher than C. Find point E, penetrate point E. There's your buy trigger right over there. Let's go on to another one. The opposite situation. A top. New high in price, A, correlating to momentum at point B. The highest momentum at point C. Price at point D. A is higher than D while B is lower than C. There's the point E. Penetrating point E gives us the trigger. Appreciate what we're doing here. If you know the Elliott wave, you know that it's subject to interpretation. There is no interpretation here. These points are written in stone. It's either there or it's not there. And as I said many times before in today's session, if you know the procedure and you work on it independent of me, and you don't have a learning disability, and I'm a good teacher, we will come to the same conclusion all the time, not just about entry and exit and setup, but about trigger and follow through as well. Let's go to the next one. How about this? Snapchat. How did Snap bottom? Well, let's look at the chart. You will notice that I'm showing you something different now. I'm showing you an MACD chart. So as I said before, we can use 4 different indicators for divergence. MACD 9 and 18, momentum 28. If you use 4 of them, you take whichever one triggers first. All 4 of them triggering at the same time, which does happen, tends to give you better results. Well, fortunately, my associate, Chris Moody, who's a brilliant programmer and trader, has been able to program this so the computer can put everything on there that we need. We don't even have to do it manually anymore. So you can see what happens. Computer draws in the first point, point A, which is right over here, new low in price. Here's point B right over here, point C right over here, point D right over here above point C, and the computer draws in our trigger point, which is right over here, and gives us our buy trigger right over here. So let's look at another one. We've also been able to program this to look at setups in TradeStation with different pairs, grains and energies, and so forth. Now let's talk about profit target. Profit target number 1 is 50% of the range between A and D. Profit target number 2 is 100% of the range between A and D. Profit target number 3 is 200% of the range between A and D. And then I have my 2% and 5% futures trailing stop. If you get advanced to the point where you're actually understanding this, although I stress it's extremely simple. Let's go on to the next slide. So let me tell you about momentum divergence. Number one, it's a leading indicator. You will know ahead of time that something is going to top or bottom. It's not 100%. If it was 100%, we wouldn't be here today. But it's highly accurate. Number two, it's effective in all time frames. Now remember this, the world is full of people who want to day trade. I wrote the 3 best-selling books from McGraw-Hill on day trading, The Complete Day Trader. Day trading is the most difficult thing in the world now. It used to be easy a long time ago, but it's not anymore. So before you think about small time frames, remember this. The smaller the time frame, the smaller the profit, the greater the inconsistency. So don't even think about that right now. Think about significant time frames. Think about bigger time frames, which are more important for big moves. Number 3, it's 100% objective, by which I mean it's rule-based. I told you the rules. The rules are very simple and they're outlined on this webinar, on the slides. The next one. In my view, it's the best method for spotting tops and bottoms. Very simple, very straightforward, and you can use it, as I said, in any time frame whatsoever. It's not subject to the limitations that moving averages are subject to. Most people use moving averages. Moving averages in the traditional way do not work. Let's go to the next point. You can use it in all trading platforms that have momentum or MACD or rate of change. Very simple and very straightforward. There's nothing secret about it. You can calculate it by hand if you want to. You can use it in all markets, including Forex, and you can use it as a confirming indicator. So let's go through another example. How about this one? This is a recent trade in GE. Daily chart. Price at the top, MAC, and momentum at the bottom. What do? Again, think about what I showed you. The first thing you want to do is ask the question, where is the highest high or the lowest low? The highest high in price occurred all the way back to the left, and at that time, that was also the highest momentum. What about the lowest low in price? I'm going to mark the lowest low in price, like so. I think you'll agree that is the lowest intraday low. The question now is it also the lowest momentum? The answer is no. Right now, having taken only 2 steps, I'm very clear. I have a bullish divergence. Bullish divergence indicates the bottom is developing. And because the bottom is developing, I want to find a place to buy. But I can't buy anything until I've got a setup. The next step in the setup, if you've been paying attention, is to find the lowest momentum previous to this point, right over there. And to correlate that point with the price. So now we've got our 4 points, completely objective, easy to do. A, right over here, B, C, and D. What's the next thing I need? Think about it. I need a trigger. Without a setup, there can be no trigger, and without a trigger, there can be no trade. I put in my trigger point. That's the number. How do I know that's the number? Well, this line represents the number. Every point on that line is a number. By going to my data, I know what that number is. I go like so, put my point over here, and I know exactly what my buy is. And here's what the chart looks like on my work. A, right over here. B, C, D, And the highest point between these two lines inclusive is right over here. And guess what? It triggers the very next day after the low. How good is that? Now what's the next thing we need? Setup, trigger, follow through. Risk, profit target. Simple. Measure the range between the highest high and the lowest low during the period of divergence. That is right over here. $1.56 a share. Intraday high, intraday low. Half of that becomes our first target. The entire range becomes our second target. Twice that range becomes our third target. What happens? Not only do we achieve all of our profit targets and then some, but it turns into another situation. So I'm not going to say anything right now. I want you to look at what's happened recently. So the trade worked. It was beautiful. It was about as perfect as you can get, but something else has happened recently. And what is that thing? New high in price without a new high in momentum, A, B, C, D, E, and right over here, we triggered a sell. Now, I did not sell short GE because I refused to sell short a cheap stock. But if you still had your position, you'd be out. But with the trailing stop procedure that I use, you'd have been out well before that divergence turned into a sell trigger. Let's see how much time we have left. We've got a few minutes left. Let's go to the next chart. Here's another one. Again, if you see any similarities here, it's because the methodology is very simple and very straightforward. The methodology is, again, let me run through it with you. A, new low in price. One moment, please. B, C, D, E, trigger. How good is that? One day after the low. Profit target calculation, $202 for the full range per 100 shares. Both profit targets achieved. That's all there is to it. So, I'm going to finish a little early, give the next speaker an opportunity to talk a little more. If you need to reach me, I'm Jake at trade-futures.com. Visit my website. If you find anything interesting in there, you might enjoy it. You might learn something from me. If there are any questions and the moderator wants to relay any questions to me, I'll be glad to take them before I call it quits.
Yes, you actually have a few questions.
Sure.
You have one from BBC, and he said, what's the momentum indicator you use?
Momentum 28.
Momentum 28, okay?
Right.
And then you have another question from Mikey G. He asks, does this apply to futures, i.e. the mini S&P?
Boy, does it ever.
Okay.
Futures, stocks, Forex, intraday, daily, weekly, monthly, every time frame, period.
Okay. And you have one last one from Mr. Barry Houston. He asks, how can he get a copy of your presentation?
Send me an email, jake at trade-futures.com, and I'll send you my PowerPoint.
Okay.
Are you guys recording this?
Yes, we are. So
you could get it that way too, right?
Yes, we will send out. Yes, we will send out the recordings of the entire presentation.
Good. Anything else for me?
That's about it.
Thanks. I've enjoyed the opportunity. I hope you guys do well with it.
Oh, sorry. One more.
Yeah.
Mr. David Merlin, he put down his email. He wanted to, I guess, the video that you said that you would send him for free. He would like to get that video.
Just send the request to my email address, jake at trade-futures.com. I'll send the video out to you right away.
Okay.
Cool. Thanks a lot, and thanks for inviting me.
No problem.
Take care, guys.